Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a happy Sunday to you. Thanks again for tuning in. You're listening to In the Know Radio. Our job is to make sure you get retired and stay retired. And we're going to enhance that retirement so that you're not surviving. We're enhancing it so that you're going to be thriving. And that occurs when you pay attention to winning, but it starts with winning at the margins. Because when you're consistently and constantly winning at the margins, you're going to win big over time. So that is a tax thing. That is a investment thing. It is a cash flow thing. It is a estate plan thing. It is a retiree healthcare thing. It's an everything thing. That's what VestGen Wealth Partners is here to deliver, is to give you all of that information. If you want to connect with us, we're a phone call away, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. I thought we'd talk in the A block this morning, David, about something that's responsible, something that everybody needs. Because if you've got people that you love and they love you back, you need to move past the fear and inhibition and focus on controlling what it is that you can control. And here's where that comes from. David, what are the two topics that everyone seems to spend so much time lambasting or contemplating?
Yeah, everyone's trying to scare you that if you don't have a will, the state has one for you, or that everybody needs a trust because if you die, you're going to have to pay a whole bunch of taxes upon death.
Those are the two things you hear all the time. I don't want to give you that. We're here for sincere and actionable ideas. So let me just remind you of what's got to happen. Everybody, you need to have control of your health care. And that's going to be in the form of a living will combined with a durable power of attorney for healthcare. And in those documents, let's get our language right. David, are we naming executors, trustees, or something else?
No, we're naming an agent. And think of that agent like your advocate. If you can't make healthcare decisions for yourself, you're going to have to nominate someone to make those on your behalf. Because you end up in the hospital, you need someone to advocate for you to get your doctor's records. Maybe you want to get a second opinion.
Absolutely. So the A in agent stands for advocacy. That's going to be your best friend in life. She's going to be your wife. It's your spouse, whomever it might be. That's who your agent typically is. And then you're probably going to name someone in line behind that agent. There's not going to be co-agency. There's just going to be an order of agents with a waterfall. And then you've got all these people that you love, and you're probably going to grant them a HIPAA waiver so that if they're in the hospital, they can at least talk to the doctor to find out what's going on, or those people can help gather and culminate together access to your medical records without any encumbrance, both records in the digital form and in the written form. And you just got to have all these nuances navigated. So part number one for absolutely everybody is if you haven't refreshed your durable power of healthcare to name agency, to grant people the right levels of HIPAA, those are privacy waivers in the last 5 years, it's time you redo it. 833-964-PLAN. That's 833-964-PLAN. But David, just as there's a durable power of attorney for healthcare, there's a durable power of attorney for something else. What is that?
Yeah, we've got to have a durable power of attorney for property. And now while we call it a durable power of attorney for property, I think a better way to think about it is it's your financial power of attorney. It has to do with taxation, investment accounts, bank accounts, real estate, etc. So using that same example, if I'm laid up in the hospital, I nominate Brooke, my spouse, to go ahead and make healthcare decisions for me. Now, In reality, I'm not worried about Brooke running out of money, because if I was in the hospital, Brooke could just go to the bank and she could withdraw money, because we hold a lot of our assets at the bank jointly, a joint checking account, a joint CD or money market account. But Craig, for us, a lot of our net worth, just like a lot of our listeners, our net worth's tied up in retirement accounts, 401ks, IRAs, deferred compensation packages. And the challenge with that is those accounts are held individually, right? The I in IRA stands for individual retirement account. And I can assure you that Brooke, my spouse, is named as that beneficiary. But if I'm temporarily incapacitated, Brooke has no legal authority to withdraw money out of my 401k or my IRA. So we have to have a document that's going to give her access if she needs to withdraw money to pay the bills. That's that durable power of attorney for property, your financial power of attorney. And that is a document that gets used in real life all the time.
Like all the time. And here's the problem. The institution, the insurance company, the bank, the brokerage firm, they're going to want a relatively fresh document. You might have a document you created in 2014. I'm not going to argue that by statute it should be accepted, but oftentimes institutions are hesitant to accept something if it hasn't been refreshed in the last 5 to 7 years. So give us a call today at 833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com, because you got to make sure you've got the best documents while you're alive to advocate for yourself or to advocate for a loved one. That's your durable power of attorney for healthcare and your durable power of attorney for property. But then that brings us into something, David. It brings us into this concept of a trust. Who needs a trust? Who doesn't need a trust? What do trusts do? Let's break down that topic for our listening audience.
Yeah, and we're not here to tell anybody what document is perfect for them, but what we are here to talk about today is real life experiences and things that you might want to think about as you're drafting your personal documents. So the first thing I think about all the time is one of the big reasons a lot of families draft trusts is they want simple administration when they're gone. Maybe they just say, hey, when both of us are gone, I want the money split evenly between my kids. We want to avoid probate because we don't want them to have to wait a while to get these assets. And so one of the challenges that we sometimes see is people draft testamentary trust. And the challenge with that is the process of funding that testamentary trust is actually probate. So I'm not sure where that issue happens. I think it's maybe just poor communication between the end goal of the client and possibly the attorney. But if our goal is to avoid probate, we might not be wanting to use a testamentary trust. We might want to use a revocable living trust. Now, revocable living trusts also come in lots of different forms. Sometimes we have joint trusts, and sometimes we have what I call AB or his and her trusts. And I think, Craig, from my perspective, I think having a joint trust in practice, what I see, is a really good solution for a lot of families. Because if they have joint investment accounts or joint bank accounts, I don't see any reason why they couldn't have a joint trust. But the one word of caution I'll give people is life is dynamic and things change. And we want to make sure that if we have a joint trust with our best friend in life, that we enable our best friend in life to make modifications. So if I pass away first, and Brooke says, hey, look, I needed to change the beneficiaries on my account. Maybe there's a new charitable endeavor that she's passionate about. I trust she'll make the right decision for her family. And I want to make sure that she's not encumbered, or I want to make sure that the covenants of that trust don't become irrevocable at first death.
That is so critical. You just heard it from David. If you've got people that you love, giving money to them through an estate plan is easy. But if you've got people that you love and you need messaging, like I want the money to stay through the bloodline. I don't want my money being attached to a divorce. I don't want my money being attached to creditors. I want this. I want that. Then you need trust mechanisms. And most importantly, if you're married a lifetime, Don't be afraid to simplify. You've held assets jointly for so long. It's okay to do some joint trust work in certain circumstances, but make sure your trust isn't boilerplate. Have the preparedness and flexibility to recognize that if you die, your spouse is going to need to change things over her time, so that little nuance is there. David, there's something else, and this is missing in almost all these documents. It's digital asset provisions. I tell everybody right now, where are the digital asset memorandums in your powers of attorney inside of your trust account? Because if you are not creating a digital executor, if you are not creating a digital trustee, you run the risk that access to accounts, access to photos, access to social media, access to email, all these things is going to get shut off. And that is going to create a big problem. So if you don't have a digital executor, you don't have a digital trustee in your estate plan, you need to get one today. I want you to consider giving us a call at 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretiredstayretired.com. That's getretiredstayretired.com. When you're on that website, download our guide to estate planning or our guide to real return investing that we've been talking about throughout 2026. So you too can be future proofing, not just your estate, but future proofing your purchasing power, which matters in times like this. All right, we've got great information on the 40% of your portfolio. That's coming up after the break. You're listening to Craig and David Bolanos. This is In the Know Radio with VestGen Wealth Partners on AM 560, The Answer.
You want more In the Know Radio? You want more In the Know Radio? You can't handle more In the Know Radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
I tell you what, David, that last segment on estate planning, brilliant, but we're not done yet. There's something that I think we failed to acknowledge. Everyone is trying to raise revenue. And raising revenue, David, is a nice way of saying what?
Increase your taxes.
Increase your taxes. And as a reminder, if you live in Illinois, Springfield wants a piece, everybody. And David, in the state of Illinois, when you have a net worth that exceeds how much, once you exceed that net worth, Springfield comes for a piece. Where's that line in the sand?
Yeah, once we're north of 4 million, anything above 4 million is potentially exposed to death taxes if you don't have the proper planning. So we got to put in the work, especially after a rip-roaring market the last couple of years. Asset levels are higher. And let's also remember, this isn't just about portfolio assets. This is real estate, portfolio, bank accounts, and oftentimes can include your life insurance, which could put people inadvertently over that limit. So let's make sure we have the proper planning, because the reality is as we know, we're having a hard time holding on the bears, right? So they're coming after every dollar they can get, as are the feds as well.
That's right. So if you are listening and you have your house value, your retirement accounts, your bank accounts, your net worth per se, and it's above 4 million, and you're just learning about the Illinois state taxes for the first time, you got to give us a call, 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. I know what you're thinking. You'll eliminate those Illinois death taxes by going to free Florida. That's why I call Florida free Florida. Everyone loves free Florida. But if you're listening to the station right now, you're probably in Illinois, and you're probably here for good reason. Your family here, you're settled here. So let's help you neuter those Illinois taxes in Springfield so you too can make sure your money goes where you want it versus where the legislators want to send it. But that ties into something, David. It ties into this thing That's the national debt, and ties into the simple fact that borrowing money, which does have to do with our portfolio, I think is square in the crosshairs today. And there are some warnings that investors should heed about the safe money in their portfolio. And we need to give people the sincere ideas they need to implement better. So, David, what am I hinting towards?
Yeah, as you alluded to, whether it's the state of Illinois or the feds, they need to raise revenue. And one of the ways they do that is, in certain cases, they might charge you to die. They levy these death taxes. I think today, Craig, we're running $37 to $39 trillion deficit. And while I think a lot of listeners might say, hey, you know what? We've always been running a deficit in this country. What's the big deal now? I do think after 2025, it's becoming more evident that it is affecting our money. One of the things that we saw in 2025 with the announcements of the tariffs is other countries started to allocate a portion of their capital outside of U.S. Treasury bonds. They started using alternatives. They started adding money to gold because they didn't want to put every dollar into U.S. Treasury bonds. And that does have implications for portfolios. And I think if we're just being very direct about it, the challenge in portfolios hasn't been the equity portion of capital. It's been for those more moderate investors, balanced investors, folks that have target date funds. They've maybe not noticed that the safe portion, the bond portion of the money, really hasn't kept up the last couple of years. And that's not due to default risk. That's really been due to interest rate risk. And with interest rate risk, right, it's a pretty simple equation. As interest rates go down, generally bond prices go up, but also vice versa. And when we moved interest rates down several years ago to re-stimulate our economy after COVID, once you're at zero, there's only one way to go. So interest rates have moved up. That's put pressure on bond prices. And while you could argue bonds haven't been decimated, they also haven't produced the returns that maybe investors have been accustomed to the last several decades. And I think what we're offering today is perhaps a different method of investing the safe portion of the capital. It's not saying that the asset class is dead. It's recognizing that we're a unique environment today, and we might need to execute using different investment vehicles or maybe some different solutions to support the stable part of the portfolio.
Oh, that makes me say our two favorite words when it comes to the safe money in your portfolio. I think, David, we call them permanence and definition. So here's how we're going to get permanence and definition into your portfolio. If you're still using solely bond mutual funds or solely bond index funds, you're missing that permanence and definition, and it could cost you dearly. David, I'm going to have you tell everybody in a minute what the 5-year return is on the total bond market index, because everybody knows it's going to be low. I think they just don't know how low it is. But here's how you prevent from getting trapped in that number. I want investors listening to this show right now to commit to do the safe money better. And we're going to do the safe money better by building out what are called ladders, bullets, or barbell strategies. And those aren't products, those are strategies. And once we start deploying with better efficacy what we call barbells, ladders, and bullet strategies, we can then be implementing with individual bonds, that's individual credits, because when you have an individual bond, you know exactly when that bond matures. You know exactly when you're going to get your principal back. You know exactly what your yield to maturity is going to be. That's the permanence and definition. And for those who aren't comfortable with individual bonds, we can complement those individual bonds or replace those individual bonds with bond ETFs that have guaranteed maturity dates. Because if you have a bond ETF that matures in 2028, it might have several hundred bonds in it. And guess when all the bonds mature, David? By December 31st, 2028. Once again, allowing you to calculate when you're going to have a return of principal from maturity and what your yield to maturity is going to be. So that simple shift that David mentioned of changing the platform, which is changing and leading to an improved vehicle. Bond ladders, barbell strategies, bullet strategies, platforms, then implemented with individual bonds or bond funds that are institutionally priced with guaranteed yields to maturity is going to make you so much more successful. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. David, why is VestGen Wealth Partners doing such a better job of building out the fixed income side of the ledger than the traditional advisor working in a solo office?
Well, I'll tell you how we execute, but I think here's the number that people want to know. 0.14. 0.14 is the 5-year annualized return for the bond market index. That's the motivation for building out a more sophisticated fixed income strategy at VestGen, is because those numbers have been pretty stable the last several years. And all VestGen did was just get additional capital, as in human capital, to put all of this stuff to work. So if you said, David, plainly, what's the difference between VestGen and an advisory firm where there might only be 2 to 3 employees? We employ people specifically to manage these bond ladders to specific maturities related to people's cash flow models. So it's customized to them versus a 2 or 3 person shop who doesn't have the capacity to customize portfolios across the board. So they have to take the easy way out, buy a ticker symbol in a portfolio. And while it's adequate, it is not ideal. And if you're a listener out there who's listening to this show, you don't want to be okay. You want to learn how to go from okay to good and good to optimal. And you recognize that it's about winning at the margins. So when we say these things, someone might be thinking, hey, what's the big deal? I'll keep going with the ETF. The ETF is fine. But if you want to start winning and making meaningful progress, listen to what we're talking about doing. Reducing cost, creating tax efficiencies, and matching your fixed income portfolio to your family's financial plan, your cash flow model. That's a better way to get it done, in our opinion. And that's what we offer at VestGen.
Absolutely. So connect with us. Go online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Phone number 833-964-PLAN. That's 833-964-PLAN. I encourage you to download today what we talked about in that A block. The items you need that are critical right now for your estate plan. Download our estate planning guide for free. And since we were talking about preserving purchasing power, everybody knows the bond side of your ledger is about staying wealthy, but because you can't spend percentages, you only spend dollars. I want you to learn about real return investing. So go to our website, GetRetiredStayRetired.com, and download our guide today on real return investing so you can start shifting the narrative to what really matters, which is protecting and preserving your purchasing power throughout your retirement. You're listening to Craig and David Bolanos. This is In the Know, VestGen Wealth Partners on AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
Hey, welcome back. Gotta tell you, there's another side of the ledger. We just got done talking about the fixed income side of your portfolio, the safe money, and what you need to be doing to improve your results. But there's the other side. It's the fun side. It's everything that's tied to the capital markets. Capital markets that are both publicly traded, but what about those markets that are privately traded? David, lead us through a narrative here of what we're doing at VestGen Wealth Partners and what our perspective is on how to improve the results on the equity side of the ledger. Define the challenge and the problem, and what are some of the pathways to start winning?
Well, I think one of the reasons people may not have noticed the safer money kind of being a drag on the portfolio is the stock market's done well the last several years. So it kind of masks the fact that bonds have just been kind of steady Eddie and not really growing. But I think the challenge for some listeners out there is they're saying, hey, look, the stock market's going up, but, maybe like I'm just not keeping up. And I think there's lots of different reasons why that happens. But I think one big challenge is when we have market gyrations, it sometimes forces people to make an emotional decision and they get out of the market. And one of the ways that I think we can bridge the gap is when you don't understand what you own, sometimes you're less likely to stay in the game when that volatility picks up. And one of the ways that I think we do a good job implementing for everybody, Craig, is we don't have to load up everybody's accounts with a whole bunch of mutual funds where they don't understand what they own. A lot of times we like to include individual stocks, what I call great companies of America. Because if you understand what you own, when times get tougher in the markets, yeah, it might get you a little bit nervous, but you won't be quite as eager to sell if you understand why that business model is relevant today. And so when I think of these, what I call great companies of America, they've got a couple really basic characteristics. First, they all have wide moats. That's what Warren Buffett uses to explain a good competitive advantage. Number two, you understand what the company does, why they're relevant today, and why they will likely be relevant in the future. These are companies that have management teams that put shareholders first. And I think a big part of retirement is cash flow. So a lot of these companies also generate dividends. But think about it like this. Yes, the stock market goes up and down, but do you think people are going to stop ordering packages for delivery at their house? Probably not. So these are companies that you can stay in for the long run. But I think that dividend component's really, really important. We know historically that non-dividend paying stocks have outperformed stocks that have cut or eliminated their dividends. But companies that grow their dividends or initiate new dividends do better than those other categories I just mentioned. And if you think about it, historically, a lot of the innovative companies in America have not paid dividends, but a lot of these big technology companies have initiated dividends at investor demand. And I think that's a really good thing. Might not be the highest dividends, but they are growing those dividends over time. Now, let's break down dividend growth because there are two schools of thoughts. Neither one is correct. Some people like buying stocks with very high yields, high dividends. Other people, put myself in this category, like buying stocks of companies that are growing their dividends very consistently. Perhaps we build and craft and curate a portfolio where the companies are growing their dividends at a rate that exceeds inflation. Now, that dividends growth rate, I think, gets overlooked. So maybe we read in the paper tomorrow, company ABC has decided to increase its dividend from, say, 50 cents a share to 54 cents a share. Now, you might gloss over it when you're reading that on Yahoo Finance, but the reality is going from 50 cents a share to 54 cents a share is an 8% increase in cash flow. Think of your other retirement income sources, Social Security, your pension. Do you get an 8% increase or cost of living adjustment on pension or Social Security? No. The responsibility, I think, to grow retirement income is on the end investor. So we have to have some things in our portfolio that are going to generate additional cash flow, grow every year. And dividend growing stocks, I think, are a great tool to have in your retirement portfolio as you try to build wealth and preserve purchasing power over time.
Absolutely. 833-964-PLAN. 833-964-PLAN. Go out to our website. GetRetiredStayRetired.com. Invest in America. Invest in great companies of America. Those companies that are generating sustainable free cash flows, and those sustainable free cash flows turn into dividends. And when those dividends are growing every single year, that means you're growing your income. And if you're growing your income, you too are going to start thriving in retirement, not just surviving. So part of what David was talking about was getting back to basics. And that's why we want you to connect with us, because you too shouldn't just have mutual funds. You shouldn't just have ETFs. There's nothing wrong with owning individual companies that you can identify with, harness the power of dividends, and especially if those dividends get you to the power of zero, tax-free dividends. Oh my gosh, that's even better. 833-964-PLAN. Go out to that website, GetRetiredStayRetired.com. But David, there's people who are also concerned about volatility. I mean, how can they not? We've been to heck and back. We've had 6 or 7 seismic events ever since COVID. Then the massive supply chain shock that occurred. Then the massive fastest rise in inflation, courtesy of the follow-on act of the fastest rise in interest rates to combat it. You had the situation when we had to bomb Iran the first time, nuclear reactor, bomb them a second time. You had Israel. The list goes on, David, and I get it. You've made so much money. You're listening and you can't believe how well the market's doing. Maybe you too should look at doing some cap and cushion. Maybe you too should be looking at some buffered products. How do you stay in the market and reduce your downside, or how do you stay in the market and eliminate your downside? You know, right now, people don't have to buy an annuity. You could buy a product, a structured alternative investment tied to the S&P 500 with a 1-year time commitment. In that 1-year time commitment, in a very friendly, tax-efficient wrapper, you're going to participate in the stock market's upside, but only to a cap. And that cap, maybe it feels low, but that cap is around 7.5%. In exchange for having that cap, you can make up to 7.5% profits in the ensuing year. Guess how much downside you have? Zero. None, zip, zero, zilch. Maybe you want a higher upside in exchange for not absolute, but some downside protection. That can be structured too. And the beautiful news is it can be done without tying your money up for 7 to 10 years. So there's different ways to accomplish different things in today's marketplace. And if you find that the volatility, you find a little bit of worry about the noise, you're worried about the fact that the midterm election's not going to go your way, you want to start locking in some paper gains after 3.5 years of double-digit gains, you should give us a call at VestGen Wealth Partners so we too can show you how to structure absolute, buffered, various forms of defined outcome investing on the equity side. I like to call it cap and cushion. How much cap do you want in exchange for how much cushion you're going to get? If you want to learn more, you can and you should. Give us a call, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. If you think I'm enthusiastic, I am, because this is the information you want and crave, and we're not here just to give you information. We're here to help you implement. This is Craig and David Bolanos, VestGen Wealth Partners, in the know, AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
I think it is so critical that people don't just look at the public markets, but you can't deny the power of private markets. Everybody just saw the SpaceX IPO. That was a private company bringing a portion of its shares public. All of these great stories of innovative companies that are disruptors, Start private before you even have a chance to get public. And if you don't have private market access, you're never going to have an opportunity. But private market access can come in two forms. It could be at risk, which is wealth building. It could also be about de-risking. And we want to make sure we help you put a halo around a part of your portfolio because you need the help. David, what does halo represent to us?
To me, halo is hard assets, little obsolescence, refers to companies and real assets whose values rooted in large, capital-intensive physical infrastructure. Because everybody knows that AI has been pushing these markets higher, and I think that's a great part of everybody's portfolio. But let's be honest, everybody's 401k has a piece of those big semiconductor companies. What we're talking about is, as folks look to maybe take the edge off their portfolio, perhaps we rebalance and transfer capital to some of these companies that support those semiconductor companies. They support all of the big tech companies that we see on TV. And while there are publicly traded companies that can do that, there's also a lot of private infrastructure out there. And just as AI is a long-term trend, I'm a big believer that these private infrastructure companies are also seeing a major long-term trend, because we know regardless of where you are in the world, our infrastructure is not set up to handle this massive build out, nor is it set to handle the massive energy demand that's coming as everybody's on their phones using ChatGPT, etc.
So if you want to own the data centers, the cell towers, the fiber optic networks, the energy production and the energy transmission, all of those are going to help you put a halo around your portfolio to give you returns that sit in between equities and fixed income. And it's so important to do in a world that AI can replace and AI can, in fact, reprice. Okay. 833-964-PLAN will help you put a halo around your assets with the right form of infrastructure. Or getretired.stay-retired.com. That's getretired.stay-retired.com.
Now, Craig, I think a lot of people out there are thinking about, geez, we're talking about this estate plan, talking probably a little about taxes in a couple minutes. We're talking about different parts of the portfolio. Now we're talking cap and cushion. How does all this stuff come together? Here's what I want people to think about. A lot of people out there have done the hard work. They've put in the sweat equity. It's everything they've done without. They've added to 401ks, 403bs. But I think as good stewards of capital, a lot of these people know that being a good steward of capital is just about being a good student of the game. And what people are looking for today is, how do we start piecing all of this together? That's the vast majority of families I think we meet today, is they are directionally correct. They've put in the hard work. Our job is to optimize all of this stuff and create a documented roadmap so they can figure out how much should go in these different places and what are the top priorities and what are the things that we can perhaps put on the back burner. And when I think about retirement planning today is not a conversation with your advisor where it goes like this: I'm nervous about the markets, and the advisor says, don't worry, you've got plenty of money. There should be a rhyme and a reason why things are going to be okay, documented in a plan. But in order to have a good plan, to me, you've got to align yourself with a firm, a group of people who is thinking 2 steps ahead. Where does your family need to be in 4 or 5 years? And what are the small strategic steps that we're going to take to get you there? Because in finance, you can't deal in absolutes. You can't completely undo a portfolio overnight. And I think that's why we spend all of this time on the planning side of things, Craig. I mean, look, the investments get me excited. I know they get you excited, but at the end of the day, having good investments alone isn't enough to get it done anymore. All of these investments come together with a plan.
I think that's so critical. And it's not just the cash flow plan that David's alluding to. In addition to that cash flow plan, it's going to be what? It's going to be your tax strategy. So let's go there. I mean, right now, Think about what the One Big Beautiful Bill Act just did for everybody and ask yourself this question. Did you or did you not take advantage of the higher SALT deduction? Oh, yeah, SALT deduction. I'm talking about your state and local taxes. And hey, if you're a business owner, are you taking advantage of the PTIT, the pass-through entity tax, to pay your state tax liability out of your business to ensure it's fully deductible, even if you too exceed the SALT cap? I know you're scratching your heads and thinking. Call me, 833-964-PLAN. Let's maximize your SALT cap. Number 2, what am I thinking about here? Hey, business owner, this is for you again. You need to be revisiting your entity structure. You need to be visiting. Are you an LLC? Are you an LLC with a sub S election? Are you still a legacy C Corp when you really should be a sub S? What are you doing to save on taxes? What are you doing to eliminate double taxation? And above all else, courtesy of OBA, it's still here, Qubit. I didn't say Qbert, from the 1980s, the video game. I'm talking Qubit, your qualified business income deduction. You need to be maximizing your Qubit. VestGen's going to help you do that. In addition, we're talking about tax leverage. Think about the new tax deductions. Did you miss out on the senior bonus deduction? Did you even know there was a new senior bonus deduction? It could be worth up to $12,000 if you're married filing jointly. Next, what do I think about? I think about the vehicle. Are you buying the right vehicle? Last time I checked, there's a provision for the deductibility of auto interest. Did you miss that on last year's tax return? In addition to that, think about everything that's happening with the eligibility of tip income, overtime income, all these other things. Now, in addition to that, part of that tax leverage, you got to be thinking about your retirement withdrawals. I mean, with today's tax rates sticking around, you've got more flexibility than ever to solve for getting income that you might have been taxed, that was tax deferred when you were working. And when you were working, you were probably in the 24 to 32% bracket. Now you have an opportunity to redistribute some of that income at 10 to 12%. Gee, I don't know, 24% to 32% deferral, 10 to 12% distribution. That's tax arbitrage. How good is your advisor on creating tax arbitrage for you with your IRA withdrawals and proper sequencing? Of course, Roth conversions have to be a part of the plan. Roth conversions have always been a part of the plan. And please, for those who have already made it, if you've made it, you're probably wondering why your friends at the country club have slats, spousal lifetime access trusts, and you don't. Maybe you too should have one. You might have been to that fundraiser, and people talked about their crits, gruts, and grats. And you're like, wait, why don't I have one of those? Maybe you should. I think we can help you make it a can. And for everybody else, donor advised funds are no longer for the wealthy. Donor advised funds are for the charitable. And now that you've got higher SALT deductions compared to making more people itemize, you merge all these things together. It's tax leverage. And that's what I want you to learn more about. At VestGen Wealth Partners, it's not just an investment thing. It's an everything thing. Connect with David. Connect with myself. 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. You're listening to Craig and David Bolanos. This is In the Know Radio, VestGen Wealth Partners, AM 560, The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
833-964-PLAN, or go to our website, getretiredstayretired.com. If you listen to this station, you are an information junkie. And if you listen to the station in our show, you know that retirement plan is not a product. Retirement planning is a process you have to go through. And what we talked about today is what we do on a day-to-day basis at VestGen Wealth Partners. It's not just an investment thing. It's not just a tax thing. It's not just an estate planning thing or a retiree healthcare thing. It's all of those things put together. And at retirement, it's where all of those things come together at one single time. And if you're out there and you're saying to yourself, you know what, I think we've done a pretty darn good job with our retirement savings. And we already maybe had the opportunity to put pen to paper and draft estate documents. But what we're trying to figure out is how we're actually going to start deconstructing and turn all of this capital into sustainable retirement income. Then I'd welcome you to give us a call at 833-964-PLAN or go to our website and set up an appointment to have a cup of coffee and talk about how we actually put this together. Because putting this together is about listening and it's about defining these goals. We want to know what's important about money to you today at this juncture in your life. And you're going to want to know what our value system and our value proposition is. And if we have a good conversation, we'll have another conversation. But what we're going to start doing is we're going to start plotting these out year by year. And as we start to plot out those goals year by year, we're going to start then reverse engineering the systems and strategies to get you retired and keep you retired. We'll help you build out that next phase of your estate plan. If you've never had the opportunity to learn about private equity, direct indexing, individual bond ladders, we'll teach you how it works and see if it's right for you. If you're struggling trying to figure out what that Medicare solution is going to look like, we have people that spend time doing that all day. That's their only responsibility. So if you're ready to level up and take it to the next step, then give VestGen Wealth Partners a call. You've been listening to In the Know with VestGen Wealth Partners, Craig and David Bolanos on AM 560, The Answer.